Hey guys, what is up? Welcome to my channel. I know why you are here today because you want to invest into that 36% risk index portfolio, but you have no idea what's in it. No worries, because today I'm here to solve your problem. I appreciate the early thumbs up and it helps a lot with the YouTube channel. Thank you very much. And so without further ado, let's jump right into today's topic. So before I even begin explaining to you what is the 36 risk index portfolio about, you do know that if you are investing in StashAway, you are effectively investing into something that we call ETFs or exchange traded funds. Now if you don't know what the Bing Ding ETF is about, don't worry, I will explain to you in very simple terms. So imagine the cups right here. We have three cups: the red, the black, and also the blue cups. Blue. Okay, so imagine this cup is a company, a stock. So if I were to invest into any one of the company, there will be one stock. But if I were to invest into a bucket of stocks over here, the red, the black, and the blue, 3 in 1, that is what we call the ETFs. Now, since you are investing at multiple companies at one go via ETFs, it gives you the flexibility to diversify your investment risk, and that's why ETFs are generally more stable and low risk investment. And in return, it will charge you an annual fee of less than 1%, which what we call the expense ratio. Now, it is rather similar to a mutual fund, but not similarly, because the mutual funds are more actively managed, which is why their fee is usually 3 to 4%, very high. Okay, I hope that gives you a better understanding what you are investing into StashAway. Now, time for the more advanced part of the video. I will try to water down my language and try to explain to you as simple as possible. First of all, the 36% risk index is part of the high risk portfolio. So if we go to the asset, we can see the big pie over here. So the largest one here is the equity sectors in the US, which stands 39%, international equities at 33%, commodities in 20%, real estate 7%, cash 1%. No worries, sit tight, I will go through one by one for you. The first one that I'm looking for is the international equities, which has the Asia ex Japan, China tech, and emerging markets. So let's start by looking at the international equities. We look at the Asia ex Japan with a weightage of 5.72%. So this is the iShares MSCI All Country Asia ex Japan ETF with the ticker AAXJ. This ETF is a subsidiary of BlackRock, the world's largest asset management company. Every investor in the US knows about this company. This ETF invests into large and medium-sized companies in emerging and developed Asian countries. Their top 3 holdings include Alibaba at 9.5%, which is one of the technology giant in China that owns Taobao and financials. Some even call it the Amazon of China. The second is Tencent Holdings at 6.66%, the world's largest game and tech company based in China. I believe you know PUBG, and that is from them. And the third is Taiwan Semiconductor Manufacturing Company, TSMC in short, at 6.54%. They manufacture chips for Apple, Huawei, Samsung, and many more. Their return as at 30th September 2020 is pretty decent, almost 17% for the past 1 year, 4.2% for the past 3 years, 9.8% for the past 5 years, and 4.3% for the past 10 years. Now, if you ask me whether this is a good thing or not, I would say that yes, because technology companies have not really flourished 5 or 10 years ago, which is exactly why you see the past 1 year return is so high, because technology has just recently gained traction. So the second one that I'm looking at is the China Tech KWEB at 19.4%. The Crane Shares CSI China Internet ETF, as the name goes, it mainly invests into Chinese internet companies, as 60.3% of its portfolio is in tech companies. Their top 3 holdings include Alibaba Group at 10.32%, Tencent Holdings at 8.72%, Meituan Dianping at 8.39%. Meituan is an online platform in China just like Taobao, but more for the travelers, because this is where you can look for reviews and also shop for foods, plane or train tickets, hotels and accommodations, and many more. Just imagine this is like the combination of TripAdvisor, Airbnb, and Traveloka all combined into one. Their return as disclosed on their annual report shows that it is down 3.83% for the past 1 year, up 3.58% for the past 3 years, up 6.86% for the past 5 years, and up 10.35% since inception. And from this chart, it says that it still outperforms the S&P 500 index since its inception back in 2013, which theoretically sounds pretty impressive. The next one is the emerging markets SPEM at a weightage of 6.68%. The SPDR Portfolio Emerging Markets ETF is a subset of the S&P Global Broad Market Index that invests into either a developing or emerging market, such as in China, Taiwan, India, Hong Kong, Brazil, and more. This ETF is more consumer-centric, taking up 20% of the pie, financial sector at 18.82%, and information technology at 14.97%. Their top 3 holdings include Alibaba Group, again at 7.5%, Tencent Holdings at 5.59%, and TSMC at 4.22%. In terms of their performance, they are up 8.6% for the past 1 year, 2.45% for the past 3 years, 9.12% for the past 5 years, and 2.61% for the past 10 years. So I hope that gives you a better understanding of the international equities pie that you're investing into for this portfolio. The next one that we are gonna look at is the equity sectors in the United States. The first one will be the small cap IJR at 14.89% weightage. The iShares Core S&P Small Cap ETF invests into small cap stocks in the US, where its market cap is usually within $300 million to $2 billion. Small cap companies usually comes with higher risk, but in return they provide a better growth in the long run. The performance of this ETF is down 8.3% for the past 1 year, down 0.33% for the past 3 years, up 7.19% for the past 5 years, and up 10.53% for the past 10 years. The next ETF is the Healthcare XLV ETF with a weightage of 8.63%. The Healthcare Select Sector SPDR Fund invests into these pharmaceuticals and healthcare sectors, biotechnology, science and healthcare technology industries. Its top 3 holdings are Johnson & Johnson at 9.71%, which manufactures healthcare products and provide related services in the healthcare industry. It is also one of the few companies awarded by the European Union and the US government the contract to supply COVID-19 vaccine. The second largest holding is United Health Group Incorporated at 7.59%. They provide employers products and resources to plan and administer employee benefit programs. The third one is Pfizer at 5.08%, which is one of the world's largest pharmaceutical companies in the world, and they are also one of the top contender for the race towards the COVID-19 vaccine. The third one is the Consumer Discretionary XLY at a weightage of 14.34%. The Consumer Discretionary Select Sector SPDR Fund invests into consumer products and services such as retail, hotels, restaurants, automobiles, luxury goods, and etc. Its top 3 holdings include Amazon at 22.51%, which is the world's largest e-commerce platform, or the Taobao of US and Europe. Their next largest holding is the Home Depot Incorporation at 12.09%, which sells home improvement products just like IKEA, but on steroids because they are much more larger at a market cap of around $300 billion. And their third largest is the McDonald Corporation at 6.63%. Really? In terms of performance, they are up 23.41% for the past 1 year, up 19.39% for the past 3 years, up 16.4% for the past 5 years, and up 17.86% for the past 10 years. Wow, I'm blown. Really. The returns of this ETF is just mind-blowing, and that just shows you how much the products and services industry in the US is growing, because the number of population will increase, hence the demand will increase as well. So this is definitely a gold mine for any investors out there. The next one that we have is the real estate, the Global X US REITs at 6.57%. The Vanguard Global X US Real Estate VNQI invests into these property indexes, basically the REITs in the world except for the United States. And there are so many REITs in this world, so I'm just gonna break it down in terms of geographical location. In terms of countries, they invest mostly in Japan at 22.52%, Hong Kong at 21.32%, and Germany at 9.1%. In terms of their performance, they are down 10.62% for the past 1 year, down 1.14% for the past 3 years, and up 3.24% for the past 5 years. Now, I'm not a REIT expert by any means, but this just shows you the property and the REIT market is turning bad, and probably this is also why people are speculating that this real estate bubble is going to pop very soon. The next one that we have is commodities, precious metals at 18.76%. This is basically SPDR Gold Trust or gold in general. Gold to me is not a business because it doesn't create or provide any values apart from protecting your money in a different form of asset. And this is because gold is different from your fiat currency, your money. And usually investors invest into gold as a means of diversification. If the stock market goes down, your currency value goes down, and that is when gold will go up. Gold up. From the SPDR Gold Trust fact sheet, we can see that its return is up 25.65% for the past 1 year, but that's just because it's coronavirus pandemic, and up 12.34% for the past 3 years, up 8.28% for the past 5 years, and up 3.25% for the past 10 years. And the last one that we have here is cash in US dollar with a weightage of 5.02%. So since this cash is denominated in the US dollars, if there are any drop in the value of your currency, your ringgit Malaysia or your Singapore dollar, then your money is protected in this pie. So that is all for the 36% risk index portfolio. So just a few things I have to repeat for the sake of the viewers. Number one, the past performance does not determine the future performance. Just because it has a stellar past returns does not mean it will continue strong in the future. So remember to invest only in things that you know and invest safely. Second thing, StashAway is a robo-advisor, so it is bound to re-optimize your portfolio, and the numbers that I've just mentioned just now reflects the numbers that I have on my app currently, and it may change from time to time depending on when you watch this video. And no, I am not sponsored by StashAway for this video. And the last thing that I want to say is I am by no means advising you to invest into this 36% risk index portfolio. I am merely YOLOing into this portfolio for the sake of creating content for you guys. So help me hit that like and subscribe button because I love you guys so much. So feel free to use the referral link down below, and both of us will get our first 30,000 ringgit managed for free for up to 6 months. So yeah, that is all for today's video. I hope you gain a better insight into this 36% risk index portfolio. Let me know in the comments down below if you have any different opinion or if you want to see different types of StashAway videos, and I'm more than happy to make them. Thank you very much. That is all for today, and as usual, I will see you in the next one.